Our class will begin now, and the following explanation of accounting basics will introduce you to some basic accounting principles, accounting concepts, and accounting terminology. All these doubts in your head will go away, and once you become familiar with some of these terms and concepts, you'll feel comfortable navigating through the subject. Some of the basic accounting terms that you will learn include revenues, expenses, assets, liabilities, income statement, balance sheet, and statement of cash flows. You'll become familiar with accounting debits and credits as we show you how to record transactions.
Unless you want IRS penalties and audits, you know you have to do it. Without it, you wouldn't know your business financial health, and your business decisions would be shoots in the dark. And of course, we are talking about accounting. If you don't know what IRS is, it is the Internal Revenue Service, a U.S. government agency responsible for collection of taxes and enforcement of tax laws. People colloquially refer to the IRS as the taxman. But let's go back to accounting. So, how does accounting help to protect your business, gauge its health, and help you make better decisions? In short, why is accounting so important? Accounting and business go together like peanut butter and jelly. You can't have one without the other. But why? Let's count the ways.
Number 1, accounting keeps you organized.
Without accounting, you wouldn't know how much money your business has earned. You could easily forget how much money you have paid out, and you wouldn't remember how is your current profit and loss compared to the previous quarters.
Which customers haven't paid you? Wait, what debits haven't you paid yet? If you use accrual accounting, you should know exactly how much your accounts receivable and payable are. Number 2, it backs up your tax return claims.
Many business owners dread small business tax filing, especially if they have no idea where to start. Here is where the importance of accounting comes in.
Step 1 of filing your tax return is gathering financial records. Without these records, you wouldn't be able to enter the correct numbers onto your return. Number 3, accounting holds you accountable.
If you have shareholders in your small business, you know how important it is to show rather than tell. Accounting does just that.
Your shareholders hold you accountable for the success of your business. They can observe your business's growth and success by looking at your accounting records. On another note, accounting can also help you hold your employees accountable. Keep up to date on things like reconciling bank statements and performing trial balances. That way you can catch fraudulent activity before it takes too much of a toll on your business. Number 4, it guides decision making.
Should you buy the brand new top-of-the-line printer for the office? Well, that depends on whether you can afford it. And how about your expenses? Is there anything you can cut to help your business bottom line? That depends on how much money you're spending and on what.
To answer questions like these, you need to look at data, your accounting records to be exact. Accounting can help guide the decisions you make so you avoid common business mistakes like overspending and underspending. Number 5. You can match your new strategies with hard numbers.
Before you make a change in your business, you likely conduct a risk analysis. That way, you can see if taking a risk could damage or benefit your business. But what about after the risk? Don't you want to analyze the effects of taking a risk after you do it?
Accounting can help. You have the numbers showing your business's expenses and revenue before the change. And after you make the change, you can compare the numbers. That way, you know whether your strategy helped or hurt your business. Number 6. It's necessary for getting investments or loans.
Investors and lenders need to learn a little bit about you before the investor lend you money. And that means poking and prodding into your business accounting books.
Generally, you must show investors and lenders your business financial statements. That way, they can obtain information about your profitability. Without organized accounting books, your financial statements, financial forecasts, and profitability claims won't be accurate or have any backing. Number 7. Without it, you are in trouble.
So, do you remember IRS? Handling accounting for your business isn't a choice. Although you can choose how you want to do it, your business must have an accounting system in place. The IRS requires that you choose a business structure and accounting method. Without it, your small business tax return will be inaccurate, and you know what that means. IRS audit, red flags, and penalties. So those were the 7 reasons why accounting is so important for your business. But we also cannot forget the benefits of good personal finance. Accounting, bookkeeping, is as much a personal tool as it is a business one. Money is a big problem for many people all over the world. Perhaps you are finding it difficult to make ends meet, or maybe you're trying to save for a vacation but can't seem to figure it out where all your money goes. Accountancy provides you with the skills you need to manage your money, where you can trace and categorize your expenses and effectively budget your income. This allows you to determine exactly how much you spend on non-essentials such as movies and fancy dinners, while also ensuring the important stuff such as rent and food for the family is always paid on time.
The class is divided in 4 modules. In the first, we will talk about fundamentals. In the second, about income statement. In the third, about balance sheet. And in the fourth, about accounting ratios. All of them have their importance, so it's very important that you pay attention in all of them, to don't get lost in the middle of the explanation. They are all interlinked, and no one past concept is fundamental to understand the new one. Take notes. It will help you a lot. Pause the video, go back and watch again the part that you didn't understand that well. And if you still have a doubt, just let us know in the comments. We will try our best to help you to learn accounting, something so important and present in our daily decisions. So let's begin now with our first module.
Hello guys, I'm William and today let's talk a little bit about accounting, more specifically on fundamentals. I will answer traditional questions such as what is accounting, what is financial accounting management, and what are the principles of accounting management. Many people don't know it, so let's learn about accounting. Talking about definitions now. I'm gonna bring you 2 definitions, one simple and one more complete. Now I will introduce to you a simpler definition and then a more general definition. The simple definition is the accounting is the process of recording financial transactions pertaining to abuses. The accounting process includes summarizing, analyzing, and reporting these transactions to oversight agencies, regulators, and tax collection entities. This is the simple definition. It's easy, isn't it? We already know simple, so let's go to the more general definition. A more general definition of accounting would this be: accounting or accounts is the measurement, processing, and communication of financial and non-financial information about economic entities, such as business and corporations. Accounting, which has been called the language of business, measures the results of an organization's economic activities and conveys these informations to a variety of users, including investors, creditors, management, and regulators. Practitioners of accounting are known as accountants. The term accounting is also known as financial reporting. If I defined accounting, let's go to some concepts. It's very important for the accounting study to know what accounting is, as the accountant will probably work with one every day. So, what would an accounting be? Many people don't know this answer, so this definition is very essential for everyone because all workers have an account. So, let's talk about account and how it works.
To keep a company's financial data organized, accountants develop a system that sorts transactions into records called accounts. When a company's accounting system is set up, the accounts most likely to be affected by the company's transactions are identified and listed out. This list is referred as the company's chart of accounts. Depending on the size of a company and the complexity of its business operations, the chart of accounts may list as few as 30 accounts or as many as thousands. A company has the flexibility of tailoring its chart of accounts to best meet its needs. Within the chart of account, the balance sheet accounts are listed first, followed by the income statement accounts.
Now that we know what an account is, we must know how they are organized in the chart of accounts. They take the following forms. The first is assets, liabilities, owners or stockholders' equity, revenues or income, expenses, gains, and losses. This is how your chart of accounts should be. Now let's get into the subject of financial accounting management. First, let's define the financial accounting and then the difference between the two. Financial accounting helps to analyze, summarize, and record financial transactions of the company. The main objective is to showcase an accurate and fair picture of the financial affairs of the company. And what is the difference between financial accounting and management accounting? Let's see.
The key difference between financial accounting and management accounting is that financial accounting is the preparation of the financial reports for the analysis by the external user interested in knowing the financial position of the company, whereas management accounting is the preparation of the financial as well as non-financial information, which helps managers in making policies and strategies of the company.
When we talk about accounting management, we have some principles. Basically, the main ones are summarized in 13. Did you know? If not, let's learn. They are design and capital, management by exception, control and search accounting, accounting for inflation, use of return on investment, utility, integration, absorption of overhead costs, utilization of resources, controllable and uncontrollable costs, forward-looking approach, appropriate means, and personal contacts. These are the 13 principles of accounting management. It's very important to know all. Now we already know the principles of accounting management. It's very important for us to know what credit and debit is, because for a better understanding of charge of accounts, we must understand what I debit and I credit. So come with me for the definition.
Debits and credits are terms used by bookkeepers and accountants when recording transactions in the accounting records. The amount in every transaction must be entered in one account as a debit, left side of the account, and another account as a credit, right side of the account. This double entry system provides accuracy in the accounting records and the financial statements. After identify one or more accounts, you must debit at least one account and credit at least one account. Generally, these types of accounts are increased with a debit, dividends, expenses, assets, and loss. For credit, we have gains, income, revenues, liabilities, and stockholders.
At the end of this chart of accounts, debit and credit is accounting management. Bookkeeping can be done. But what would bookkeeping be? Bookkeeping is a key piece in accounting.
Bookkeeping involves the recording of a company's financial transactions. The transactions will have to be identified, approved, sorted, and stored in a manner so they can be retrieved and presented in the company's financial statements and the other reports. Here are a few examples of some of a company's financial transactions: the purchase of supplies with cash, salaries and wages earned by employees, borrowing money from a bank.
Hello, my name is Breno and we are going to talk about income statement. What is an income statement? So, an income statement is one of the three important financial statements used for reporting a company financial performance over a specific accounting period, with the other two key statements being the balance sheet and the statements of cash flows, sometimes referred to the profit and loss statement or the statement revenue and expense. The income statement primarily focuses on the company's revenue and expenses during a particular period. In this example, we can see an income statement of sample products for the 5 months ended May 31, 2017. We can see the revenues and gains, and we can see expenses and losses. And what's the purpose of income statement? So, the income statement is an important part of a company's performance reports that must be submitted to the Securities and Exchange Commission. While a balance sheet provides the snapshots of a company's financials is of a particular date, the income statement reports income through a particular time period and its heading indicates the duration. The period of time that the statement covers is chosen by the business and will vary. Basically, the purpose of the income statement is to provide the financial earnings performance of the entity over a specific period of time. It's also referred to as a profit and loss statement or earnings statement. Here we can see an example of income statement. And what are the most common type of accounts associated with a common income statement? The income statement accounts are categorized in a variety of ways. Here are the classifications we will be using: operating revenues, operating expenses, other revenues and gains, and other expenses and losses. Operating revenues are the amounts earned from carrying out the company's main activities. For example, the sales of merchandise are retailers' operating revenues. A few examples of accounts for recording operating revenues include sales revenues, service revenues, fees earned, and sales product lines. Non-operating revenues and gains. Revenues earned outside of a company's main business activities are referred to as non-operating revenues or as other revenues. For example, the interest earned by a retailer on its idle cash balance is part of non-operating or other revenues. Gains often occur when a company sells an asset that was used in the business, and the cash received was greater than the asset's carrying amount of the company's books. Operating expenses. Operating expenses are the expenses incurred in earning operating revenues. For example, advertising expense is one of the operating expenses of a retailer. A few of the many accounts used to record operating expenses include costs of goods sold, salaries expense, fringe benefit expense, rent expense, utilities expense, depreciation expense, and repairs expense. Non-operating expenses and losses. The expenses incurred in order to earn non-operating revenues are reported as non-operating expenses or other expenses. In addition, interest expense for a retailer is a non-operating expense or other expense. Losses are reported when a company disposes of a long-term asset for the cash, and the amount of cash received is less than the book value of the asset. The accounts for non-operating expenses and losses will have debit balance since they cause stockholders' equity to decrease.
The income statement is a report that measures a company's financial performance over a specific accounting period. This statement is also known by a number of other names: profit and loss statement and earnings statement. Publicly traded companies must produce income statements along with balance sheets and cash flow statements for each quarter and each year in accordance with generally accepted accounting principles. The income statement shows a company's revenue, expenses, and net profit from both operating and non-operating activities. It lists the company's net sales, cost of sales, gross income, selling, general and administrative expenses, special or extraordinary items, and other income and expenses, which then reveals the company's gross profit, operating profit, pre-tax profit, and after-tax profit. The income statement is divided into two parts: the operating and non-operating sections. The operating section shows the revenues and expenses associated with the company's regular business activities. In the non-operating section, the company reports any revenues or expenses not directly related to its regular operations, such as the sale of investments. Generally, investors look to the income statement in hopes of seeing an increase in revenue or net sales and a decrease in expenses. The less money a company has to spend and the more money it earns, the more profitable it is.
Hey guys, I'm Franciane and now you're going to see a little bit about balancing sheet. By the end of this video, we will learn what balancing sheet is, what it's for, and its main components. Let's go there. A balancing sheet is a financial statement that reports a company's assets, liabilities, and shareholders' equity at a specific point in time, and provides a basis for computing rates of return and evaluating its capital structure. Its purpose is informs the reader of a company's financial position as of one moment in time. It allows someone to see what a company wants as well what it owes to other parties. This is valuable information to current investors, potential investors, company management, suppliers, some customers, competitors, government agencies, labor unions, and also to the banker who wants to determine whether or not a company qualifies for additional credit or loans. Now that you already know what balancing sheet is and what it's for, let's see its main components: assets, liabilities, and owner's equity, and some examples of which one that are reported in a company's balance sheet. The first one, assets, are things that the company wants, and usually its accounts will have debit balances. They are the reserves of the company that have been acquired through transactions and have future economic value that can be measured and expressed in dollars. Also include costs paid in advance that have not yet expired. Let's go to some examples. Cash, prepaid insurance, prepaid adversity, prepaid legal fees, prepaid rent, temporary investments, land, accounts receivable, buildings, inventory, equipment, supplies, and goodwill. Liability are obligations of the company. They are amounts received in advance for future service and amounts owed to creditors for past transactions that usually have the word payable in their account title. Along with owner's equity, liabilities can be thought of as a source and as a claim against of the company assets. Now, some examples. Notes payable, other accrued expenses payable, accounts payable, income taxes payable, salaries payable, warranty liability, wages payable, bonds payable, and interest payable. And the last one, owner's equity, is sometimes referred to as the book value of the company because owner's equity is equal to the reported asset amounts minus the reported liability amounts, demonstrated in the basic accounting equation. Owner's equity equals assets minus liabilities. Some examples of stockholders' equity accounts include common stock, preferred stock, paid in capital in excess of par value, paid in capital from treasury stock, and retained earnings.
In the balance sheet, the assets are on one side and equity and liabilities are on the other side. If you draw a line between the two and one on top, it looks like a T. This is what accountants use to visualize accounting transactions. It's a very helpful tool, and we're going to come back to these T accounts all the time. You can see that the left side of the T is just as big as the right side. That's because everything the company owns, so its assets, was purchased either from debt, so somebody else's money, or its own money, meaning equity. For money to go to one account, it has to come out of another. We call this a flow of economic benefit from a source to a destination. We already said that assets minus liabilities equals equity. If we rearrange this like this, we get assets equal liabilities plus equity. Both sides are always in balance, hence the name balance sheet. And that is the foundation for any accounting system. The accounting equation. The total amount of assets equals total liabilities plus equity. Both sides are in balance. With that in mind, let's see how the balance sheet looks like for Claudio. A balance sheet is always created at a certain point in time, like at the end of the business year or at the end of a quarter. In our example, it's the end of Claudio's business day. Claudio started out with 100 euros in cash, which is also the money or equity he put into the business. The cash on the left side equals equity on the right side. The balance sheet at this point is in balance. Then he spent the cash in the morning to buy the colorful plates. The plates are what we call his inventory. In the process, his cash got reduced to zero. But in exchange, he received another asset, inventory. He didn't get richer or poorer by that, right? The total amount of assets is still 100, and of course his equity is too. After he sold the plates for 5 euros each, he ended up with 500 euros in his pocket at the end of the day. His inventory is gone because he sold all the plates to the tourists. At the end of the day, his inventory value, therefore, is zero. He doesn't have any more plates. If we look at Claudio's balance sheet at the end of the day, we can see that the total value of assets, the left side is 500 euros. That's the cash he came home with. On the credit side, we only have 100 euros. The balance sheet is out of balance. As we know, this can't be. Both sides always need to be in balance. So what's wrong here? The missing component is the profit he made during the day. If we go back to the income statement, we see that Claudio's net income was 400 euros. This will be added to equity. Why? Because due to his successful business, he made the business more valuable. When he started out the day, it was worth only 100 euros, which was the money he put into the business when he walked out the door. When he came home, he had sold all his plates with a profit of 400 euros. So his business is now worth more, which is reflected in a higher equity. Net income is the link between the income statement and the balance sheet. So when we add the profit of 400 euros he achieved to equity, also the right side gets to a total of 500 euros, and the balance sheet balances like it should. So that's how it would look like for Claudio at the end of his successful day at the beach.
Hi everyone, my name is Juliano and we are gonna talk about accounting ratio analysis. Financial ratios are mathematical comparisons of financial statement accounts or categories. These relationships between the financial statement accounts help investors, creditors, and internal company management to understand how well a business is performing and which are the areas that need improvement. Financial ratios are the most common and widespread tools used to analyze a business financial standing. Ratios are easy to understand and simple to compute. They can also be used to compare different companies in different industries. Since a ratio is a simple mathematical comparison based on proportions, big and small companies can use those ratios to compare their financial information. Ratios allow us to compare companies across industries with different sizes to identify their strengths and weaknesses. Financial ratios are often divided up into 7 main categories: liquidity, solvency, efficiency, profitability, market prospect, investment leverage, and cover.
Now we are gonna see what are the main ratios for liquidity. Liquidity ratios analyze the ability of a company to pay off both its current liabilities as they become due as well as their long-term liabilities as they become current. In other words, these ratios show the cash levels of a company and the ability to turn other assets into cash to pay off liabilities and other current obligations. Liquidity is not only a measure of how much cash a business has, it is also a measure of how easy it will be for the company to raise enough cash or convert assets into cash. We have lots of ratios for liquidity, but the main ones are the quick ratio, the current ratio, and the working capital ratio. Another type of ratio is the ratios for operational efficiency. Efficiency ratios are also called activity ratios and measure how well companies utilize their assets to generate income. Efficiency ratios often look at the time it takes companies to collect cash from customers, or the time it takes companies to convert inventory into cash. In other words, make sales. These ratios are used by management to help improve the company, as well as outside investors and creditors to look at the operations profitability of the company. Efficiency ratios go hand to hand with profitability ratios. Most often, when companies are efficient with their resources, they become profitable. The main ratios of efficiency are accounts receivable turnover ratio and assets turnover ratio. Now talking about leverage. Financial leverage ratios, sometimes called equity, or debt ratios measure the value of equity in a company by analyze its overall debt picture. These ratios either compare debt or equity to assets, as well as shares outstanding to measure the true value of the equity in a business. In other words, the financial leverage ratios measure the overall debt load of a company and compare it with the assets or equity. This shows how much of the company assets belongs to shareholders rather than creditors. The main leverage ratios or debt ratios are the debt ratio itself, the debt to equity ratio, and the equity ratio. Now talking about profitability. The profitability ratios compare income statement accounts and categories to show a company's ability to generate profits from its operations. Profitability ratios focus on a company's return on investment in inventory and other assets. These ratios basically show how well companies can achieve profits from their operations. Investors and creditors can use profitability ratios to judge companies' return on investment based on its relative level of resources and assets. The main ratios to measure profitability is the profit margin ratio, the return on asset ratio, and the return on equity ratio.
What is creative accounting? Creative accounting refers to imaginative ways to present a company's accounts. Although it is not illegal, it deviates from the spirit of accounting laws. In other words, it complies with accounting rules and regulations, but it is a practice that is considered deceitful and therefore unethical. A creative accountant tries to make the company appear financially healthier than it really is. Some people refer to creative accounting as innovative accounting, aggressive accounting, and window dressing. It should be noted that creative accounting is not the same as cooking the books. Cooking the books means falsifying a company's financial statements and is illegal. A creative accountant does not provide a true and fair view of a company. That is what honest and ethical accountants do. Creative accountants exploit loopholes in the rules and regulations. They falsely portray an enhanced image of their company. Even though creative accounting practices are not illegal, governments are forever trying to reform the law. Lawmakers want to close those loopholes to prevent such behaviors. The aim in creative accounting is to make the company look better than it is. The creative accountant manipulates the positioning of assets, liabilities, etc. The creative accountant may attempt to inflate profit figures. Some firms minimize profits during their good periods to smooth out their results. Creative accountants commonly manipulate their company's assets and liabilities. They do this to conceal problems and also perhaps to remain within limits. Thank you for watching this Markets Business News video on creative accounting.
Sadly, we hit the final road. So that was today's class about accounting. Hope you all get along with all the modules and try to apply it in your business and personal life. I will assure you it'll be a game changer about the way you organize your finances. Please let us know if you enjoyed our class. We always want to improve our method and our content. Do not forget to subscribe, give us a big thumbs up, and leave a comment. See you in our next class.